Hi, I'm Mark Farber and this is Accounting Fundamentals. In our last video, we started to look at merchandising operations and inventory, and we looked at how we would account for inventory using a perpetual inventory system. In this video, we're going to look at a periodic inventory system. The difference is that in a periodic inventory system, we're not going to update our inventory but for at the end of each period. So whereas in the perpetual system, as we purchased inventory, we updated the inventory account, and every time we sold stuff, we updated the inventory account. In a periodic system, you don't do that. You leave the inventory account for the entire accounting period, and then you make all your updates at the end of the period. I've got the same transactions here. Let's take a look at how this would look. So using a periodic system, on February 3rd, and I'm going to try and squeeze these in because I'm going to need a little extra space. On February 3rd, rather than taking the $6,000, 1,000 units and $6 a unit, rather than putting that into inventory, what we're going to do is we're going to debit an account called purchases. And I'm just going to call it Perch, but that's short for purchases, and that's $6,000. And we're going to credit accounts payable, same as we did before. Okay, so no update to the inventory account yet, and that covers the purchase. Now when we sell our units on February 7th, we're going to have the exact same sales transaction. That part never changes, so it's 100 units at $10 a piece. So we're going to debit accounts receivable, $1,000, and credit sales, $1,000. And that's it. We don't do that second part of the transaction with cost of goods sold and inventory because, again, we're not updating the inventory account until the end of the period. Now we get to the next one, February 14th, and it's the same thing. We're going to debit accounts receivable. 20 units at $12 a unit is $240. We're going to credit sales. And then we have another purchase to make on February 22nd. We're going to debit purchases, 500 times 6, $3,000, and credit accounts payable. Now we're at the end of the period, and now we have to go through a process of counting our inventory. And regardless of if you use a perpetual system or a periodic system, you always have to count your inventory at the end of each period in order to confirm that the amount that you have in your books, if it's a perpetual system, matches what you physically have on hand, or in a periodic system, you need that number in order to figure out what your cost of goods sold is. So we're going to go through the process of accounting our inventory. And if we assume that this company started the year with no inventory, this was the first inventory that it purchased, then we can see that they purchased 1,000 units. They purchased 500 units over here, so they would have had 1,500 units, and then they sold 120 units, so 1,380 units left at the end of the year. So in their count, and let's just put that over here, they're going to count 1,380 units, and 1,380 units at $6 a unit. And let me just grab my piece of paper here. That's going to equal $8,280. And that's $1,380 times $6 a unit. So we know a few things now. We know that our opening inventory, we'll call beginning inventory, was 0. That's our assumption here, that there was no inventory on hand. Our ending inventory is that number there, 8280. And again, they determined that by counting the number of units on hand at the end of the period, multiplying by the price they paid, $6 a unit, and they get that. And then they also know that purchases amounted to 1,500, or in dollar terms, 6,000 and 3,000. So there was $9,000 of purchases during the period. And so we know that my beginning inventory plus my purchases minus my ending inventory is going to equal cost of goods sold. In other words, if I take everything I had at the beginning of the period, I add in all the stuff that I purchased during the period, and then I subtract out whatever is left over at the end of the period, the difference between that is what I sold. It's kind of like what we did back when we looked at adjusting entries and we looked at supplies and how we figure out how much supplies expense we had or how much supplies we used. In fact, it's exactly the same process. So in this case, 0 plus my purchases of 9,000 minus my ending inventory of 8,280 gives me a cost of goods sold figure of $720. And so now, and I'll just put it in here, let's just make a little box. Now what we have to do is we have to adjust our inventory account. And so what we will do is we will do two transactions. First of all, we'll debit inventory, $9,000. That's for the purchases that we made during the period. And we'll credit purchases, $9,000. So we take all the purchases we made during the period, and at the end of the period, in one transaction, we move all of those into inventory. And then the second transaction we're going to do is we're going to debit cost of goods sold, $720. The amount that we calculated is the cost of goods sold for the period, and we'll credit inventory for that. And if you go through the process, and I'll leave that to you to go through this and do T accounts for these transactions, as well as the ones from the previous video, you'll find we get to the exact same place. We have the same number of sales, we have the same cost of goods sold between these transactions, and we have the same ending inventory. The only difference is that in the case of the perpetual inventory system, we were keeping track of it as we went. So at any point in the month, you could have looked at your inventory account and determined how much inventory the company had. In this case, we couldn't do that. Our inventory account would have said 0 for the entire month in this particular case, and only at the end of the month when we did this calculation and then did these two adjusting entries would we know how much inventory we have and what our cost of goods sold is. And that's essentially the difference between a periodic system and a perpetual system.